What if you could take over someone's mortgage and get a lower interest rate than you could in today's market? So I know you're wondering. There's people out there that brought homes that had a 3% rate, 4% rate, and you're currently shopping in a market where rates are 6% or higher. Well, that's why assumable mortgage is important, and understanding how to assume a mortgage and the ins and outs of assumable mortgages is very important in today's market for both home buyers as well as home sellers. I'm Reginald Perryman, here to go over the details of assumable mortgages. So first of all, let's explain what is an assumable mortgage or a mortgage assumption. This is basically where the buyer assumes the balance at the current terms of the current mortgage that the seller has. So for example, let's say if a seller owns a property and their mortgage balance is $300,000 with a 4% interest rate, the buyer would come in and just assume that mortgage at that current rate with those payments. Now the issue is if the seller is selling that home for say 480,000 and their balance is 400,000, they're going to expect the $80,000 in cash difference, whatever the equity is, as a down payment, and you're going to assume the balance due on that mortgage. But we're going to talk about the pros and cons of doing this, as well as why the market is ideal for an assumable mortgage. Now, there's two types of assumable mortgages. There's what we call a simple assumption and a formal assumption. And here's the difference. First, let's talk about a simple assumption. A simple assumption is basically when the buyer and the seller both agree that they're going to allow the buyer to assume the current mortgage. So an example would be, let's say the sales price is 480,000, the mortgage balance is 400,000. The buyer would pay the seller the $80,000 difference in equity and assume the $400,000 balance at the current interest rate and the monthly payments with the remaining terms. So let's say it's 10 years left or 20 years left on that mortgage at 4% interest rate. That's what the buyer is assuming. And we'll talk about the pros and cons of that later. Now, the disadvantage to a simple assumption mainly goes back to the actual seller, because if the buyer defaults on a simple assumption, the buyer defaults, that means that the mortgage company can still foreclose on the property, and it's going to impact the seller's credit score, as well as it's going to show as a foreclosure on their credit. A simple assumption does not relieve the seller of any liability with the mortgage company. In addition to that, if there's any documents recorded for the sale, such as a deed and the property was actually transferred into the buyer's name, the mortgage company has a right to enforce the due on sale clause in the mortgage, if there is one. Most mortgages have a due on sale clause, meaning if the property transfers ownership, the mortgage company has the right. They don't always do it, but they have the right to enforce the due on sale clause. So that's a simple assumption. It's simple agreement between buyer and seller. Buyer's going to assume this mortgage. There's no additional qualifications required, and they agree to the terms. But all the risk is typically on the seller when it comes to credit rating and potential foreclosure, because if the buyer pays late every month, it's going to impact the seller's credit. Now, let's talk about a formal assumption. This is the one I highly recommend for both parties. Now, a formal assumption involves the mortgage lender that's holding the balance and holding the note on the property. This is basically the best way to do it. Again, let's give an example. The sales price is 480,000 and the balance is 400,000. Contact the lender and say, hey, we want an assumption package. they're going to provide all the instructions and requirements to do a formal assumption. Now, in most cases, the mortgage company will want to qualify the buyer to make sure they qualify for the remaining balance, not the full purchase price. This is another pro to doing a simple assumption. In most cases, the buyer only has to qualify for the mortgage balance, meaning they have good credit, at least credit that meets the lender standards, and they have sufficient income that meets the lender standards. In most formal assumptions, it can relieve the seller of any liability dealing with that mortgage. Now, there are some times when they say, okay, if the buyer doesn't pay, we can still go back after the property, and there may be some risks involved with the seller, but most formal assumptions do not have that clause in there or any language in there stating that. Again, check with your legal counsel to make sure your mortgage and your mortgage note covers that so that you're clear. But a formal assumption is what I recommend. It's typically safer and more common for the seller to do a formal assumption, and in most cases for the buyer. So let's recap those two. Now, a simple assumption would be easier for the buyer because the only qualifications they typically have to meet are to meet whatever the seller is comfortable with and whatever qualifications the seller has set. We talked about the disadvantages of that as well. A formal assumption is the one that I recommend. Now, of course, you still want to do title work, whether you're doing a simple assumption or formal assumption. People that do a simple assumption, they assume they don't have to do title work because there's a mortgage lien on the property and title was probably ran when the owner purchased the property. The issue with that is the seller could have obtained additional liens on the property. So you want to make sure that if you're assuming this mortgage, that's all you're assuming is that mortgage balance, or you're aware of everything that you're assuming. Maybe there was a construction lien on the property, the seller had windows installed, maybe there's a lien on there for that as well. Also, you have to be clear, and both parties need to understand if there's a due on sale clause, which most likely there is, what the mortgage company is going to do to enforce the due on sale clause. And as the buyer, if you are in a position that if that due on sale clause is enforced, are you in a position to refinance and pay off that balance immediately? All right. So here's why a assumable mortgage transaction makes the most sense. Let's say we're in the market and interest rates are 8%, and you had a seller that's selling a home and their current interest rate is 4%. Let's say you're buying a home, say for $300,000, and you're required to put 10% down, which is $30,000, and you're going to have a mortgage balance of $270,000 with an 8% interest rate. And this is just one example. Let's say you find a seller that's selling a home for $300,000, and let's say maybe their mortgage balance is, I don't know, 200, and let's say 270,000 to keep it simple. They purchased the home a few years back. They're getting ready to sell. Interest rates were better then, and you're giving them $30,000. It's still 10%, but in this case, you're giving them 10%, which is the 30,000, but you're getting a 4% interest rate instead of an 8% interest rate. Plus, in addition to that, even though the first several years are all interest, but they've already paid several years into that mortgage. Now, you may ask, well, what if they only owe $250,000 and you have to pay them $50,000 versus going out to get your own mortgage at $30,000 down? Well, if you're putting a down payment of $30,000, you're also going to have closing costs and other costs involved. So the numbers may work pretty much the same. So my suggestion would be consider a more assumable mortgage in most cases, especially if you already qualify for a mortgage for 300. You only have to qualify for a mortgage of whatever the balance is, doing a formal assumption. So that would be my recommendation, and that's one of the biggest benefits to buying a home under a assumable mortgage. Okay, so let's recap. So first and foremost, simple assumption is quick. The other benefit is there's not necessarily an appraisal required. You can bypass some of the lender requirements as well. A formal assumption is quick as well, but you have to meet the lender guidelines as the buyer as far as credit and income. But again, you're only qualifying for the mortgage balance, not the entire purchase price. Big difference. And what a assumption, whether it's formal or simple, the ideal scenario is you're assuming a mortgage that's already been paid several years into that mortgage. Let's say it's a 30-year mortgage. They've already paid 5 years into it, even though you're paying the equity. So it's going to average out. But you're paying a balance due that may have 20 years left, or 25 years, or 15 years, or whatever the case may be. And there's no appraisal required in either situation unless you negotiate to have the property appraised. So there's pros and cons. My recommendation, especially if you're doing a simple assumption, both parties may want to get an attorney involved to draft additional documents. Beware of the due on sale clause in most mortgages, and communicate with the lender to make sure they're aware that a mortgage assumption is happening. And if it's a formal assumption, they're going to do that anyway. So this is Reginald Perryman, regisrealestate.com. Like, share, and subscribe, and share this with your friends and family members who may be interested or need a better explanation of what assumable mortgage is.